All right, welcome back. I posted in the newsroom an uncensored video because I can't keep doing this, and if I want to rant and give my opinions about news events and everything, uh our overlord censorship, it's just my channels aren't growing, so there's no motivation for me to keep making videos. And the more videos I make, algos are going to pick up on more. So from now on, I'm going to start posting that stuff in the newsroom, which is free. The link is below the video for the free newsroom. So there you can find uncensored videos about me ranting and raving and just uncut, unfiltered. All right, guys. Now, for the videos I'm going to make for my channel, it's going to be more about TA and pretty much TA. I'm going to try to stick to that and some economics. I'm going to have to watch what I say, though, right? First of all, consult your licensed financial advisor before doing anything. Please do not invest anything in anything that you are not willing to lose or lose sleep over, meaning don't over invest, and have stops in place, emotions out, or not have stops in place, know what you're doing. If you're trading, have at least decent amount of experience, and think about the future, right? If you lose your job, do you have money to invest? Should you invest money? I don't know. Everyone's personal well-being is, they know it themselves. Don't lie to yourself. A lot of people lie to themselves. But only you know where you are at in life and how to position yourself, and try not to lie to yourself as you do that. Because if you lie to yourself, you're going to wreck yourself in life and everything else. All right? That's like a life lesson I believe is true. So, well, the mining stocks, I mean, they've been rallying and ripping higher for the past couple weeks, and over a longer stretch of time, I mean, we're massively up. Like, and if you know how to trade, if you're actually an experienced trader who knows what they're doing, you saw my calls, I mean, you're starting to get rich. I'm not gonna lie, because I went through all my alerts in the past year, and all the charts I was posting up and giving you guys reasons why I'm doing this, why I'm doing that, so you guys could learn. But let's say if you were an actual trader and you just followed those calls, I mean, you would be massively up like I am. Like I'm literally up 800% on my entire portfolio, which is huge. Like, there's no one on Wall Street doing that, I guarantee you. So, and that's with me screwing up. I had a huge screw up because I did not see the mining stocks crashing right before they did in March, because gold was looking so strong. And I'm like, okay, it's a pullback. It's just a pullback, maybe a correction, but it's not going to be that serious. And then the margin calls hit, and all the mining stocks dropped like 60%, something like that. But then they recovered very quickly within 2 weeks. But I didn't hedge. Well, I did hedge in a way because I shorted the market, and that saved me, and I even came out on top. But I wish I would have hedged all of my leveraged mining ETFs, right? Anyways, let's talk about something, because I do want to get something off my chest. Because, listen, you're not going to ever, if you're new to like investing, or even if you're not new to investing, but you're new to trading and you think you can somehow create a career out of trading, like out of nowhere, I have some news for you, because I'm not here to BS you like a lot of most people are on. Pretty much most people BS other people. You see those commercials. I have a great strategy. I have a great trading strategy formula that could guarantee you $2,000 a month or whatever. It's all bullshit, guys. Listen, you are not a trader until you have at least have been trading for like 6 years and you're profitable in the end. Meaning you've gone through years of screwing up, having good trades, because the only way you really learn is by putting your money in the market, risking it, losing money and making money, and staying in the game with. And some people blow up. Most people actually who become really the best traders, and they actually make it, meaning they can make a living off of it or get rich, they've at least blown up their account once or come very close to it. Have I? Absolutely. I've come very close to blowing up my account many years back. I once took a 70% drawdown and almost blew up my account, but my account wasn't so big that I couldn't feed the margin calls. So I was eating ramen noodles and like throwing all of my money from a business I had, and I even had a job. I was just throwing all my money into my brokerage account to not let it blow up. And I had to do that for a very long time, like 4 months or something. And it was pretty bad. It was horrible. But I came out and I didn't blow up my account, and then it rebounded, and then I kept trading and I rebuilt it, right? So until you go through something like that, it's gonna happen to you at one point or another. So thinking you could just jump into trading and making a living out of it like the first couple years or something, that's extremely unrealistic. There's that one guy who just became super famous, the Barstool guy. He just started trading. That guy, he's gonna get wrecked if he hasn't already. Yeah, he's going into it rich. That doesn't mean you're gonna come out of it rich. All right. The best thing to do when you start off trading, and know the difference between investing and trading. There's a big difference. Investing is you buy and hold. Okay? And the only reason you look at the chart is to buy the pullbacks and the corrections, because when you're investing, you're invested in a large bull market or macro trend, kind of like a super cycle. So what I'm trying to say is, a good example would be you started investing in 2009. Your overall because of fundamentals and macro trends, and because of what the Fed's doing, you knew that you have many years of equities going up. So investing is you start with a small position, and then on every pullback or correction, major pullback or correction, you buy the dips. And you do that for years, for many years, from 3 to 5 to 10 years. That's investing. Most of the time you do nothing. You just log in, or you look at the chart and you're like, oh, look, the market looks like it's dumping. But this is a smaller cycle within a larger cycle. I'm going to buy the dip. So here is the S&P 500 monthly chart. Okay. This is let's start back at you started thinking about investing back in like 2001. Dot-com bubble happened, it crashed. So you bought the dip. And then you had a nice rally for like 5 years or whatnot. You might have thrown in a little money on all these small dips, but most of your money's going into savings. And then you get a large correction in 2008, a crash. Okay, then you buy that correction. This is a correction in a macro sense. This is a multi-decade bull market, right? So you buy here, buy here. This is investing, not trading. You see another correction back in 2015. You buy that as well. And in the long run, your portfolio is growing tremendously. You also buy the dip back in 2018. And then I have to take that all away because you can't see it. Technically, you would buy this dip as well, right? And that's investing on the macro scale for your retirement or whatever. Of course, the problem with all of this is it's a bubble, and one day you might buy the dip and it's going to go up. But then what if it doesn't make a new high and it actually does crash? Then you're done. It's over. You lose everything. And that's the risk, even with investing, especially in a bubble. So you have to understand economics. Over 90% of investors and retail investors, everyone who has pensions or retirement accounts, they don't understand economics, okay? They have no idea what they're doing. That's why my channel is so important, and that's another reason why my channel is not allowed to grow. Because the platform I'm on obviously has invested interest. They have their own stock shares, the company who owns this platform, right? They want this bull cycle to never end and to keep going up. And it might keep going up for many years from now, but that doesn't mean if you sell those stocks, you're actually in profit or in gains, because inflation might end up being higher. So when you go to sell, not only do you have to pay taxes, but you have to deduct the inflation in the real world. And adjusted for all that, you're not making money. It's like a huge illusion. It's smoke and mirrors. And that's what I'm trying to warn everyone about. Okay. Another thing I want to show you guys or talk about. Let's go to a weekly chart. Okay. This is a monthly chart. If you do not understand price versus time, then you have no business investing or trading, especially trading. If you do not understand time versus price, price is the y-axis. The x-axis is time. The candlesticks is also a time horizon. This is a monthly chart, so 31-day chart. Every candlestick, these little freaking rectangles, that's an entire month. If you do not understand that, then unsubscribe and go somewhere else. Here's a weekly time frame. Every candlestick is a week. It's a week, okay? You have to, this is basics 101 of investing and trading and price versus time and analysis. If you do not understand these things, there's no hope for you. I don't know what to tell you. Okay? This is a weekly chart. Every candlestick is a week. Some of you have a hard time understanding. Some of you don't even know the difference. And this is for the private members, really. If you do not understand the difference between a dip, a pullback, a correction, and a crash, then you're just lost. I don't know. It's like you're blindfolded. So on a weekly chart, hold on. On a weekly chart, Let me give you an example. See this? On a weekly chart, this is a dip. These are dips. This, because of the velocity of it, was a crash because it happened so quickly. But on a monthly chart, if I zoom out on a monthly chart in a larger time frame, this right here is a pullback. These are nothing. It's not even a dip. And this is just a correction. This wasn't even a crash on the monthly. So technically, the stock market didn't really crash, but it did on the weekly, but it didn't on the monthly. If that makes sense. Let's do another example of this. Let's go to the daily. Okay. So if you can see my cursor, this is okay, hold on, let me zoom out, clear this up so it's not as hard to see. All right. In late 2018, this was sort of a crash right here. But the initial drop right here, this is a correction. Now, how do I know that? For one, I'm looking at the 200-day moving average, and I'm looking at my blue equilibrium line. Equilibrium means return to normal. It's not overpriced, not underpriced. It's return to equilibrium, normal. Meaning the price is always returning to my blue line. It goes below it sometimes, it goes above it, but it's always going to be around it in a long enough time horizon. That's why it's called equilibrium. See? Here's my blue line. See my blue line? The price, goes above it for a long period of time, then drops below it, but then goes back above it, then returns to it, goes back up. It's the equilibrium. So the moving averages help me determine what kind of correction we had, or what kind of return to equilibrium we had. All right. See these little, so this is a pullback, but once it broke below my blue line, it's called a crash. Well, no. Okay, so once it pulls back to the 200-day moving average, that's like a correction, or no, a pullback. Then it hits my blue line. That's a correction. Goes below my blue line. That's a crash. See these little drops right here? These are pullbacks. Boom, correction. This was a correction. See, and then it rises. These little dips right here, these are dips. Not a substantial pullback. It's a dip. It's just dipping. This right here, that's a correction. It went all the way, it fell, and the velocity of the fall was pretty extreme, and it fell to the blue line. That's a correction. You have to know the difference. This right here, correction. If we zoom in, this right here, this is a pullback. It only fell back down to the 52-day moving average. Right here, it fell below it, fell to the 200-day moving average. That's a correction. Right here, it fell to like the 14-day moving average. That's a dip. That's just a dip. Do you understand? So this is a dip. This is a pullback. This right here is a correction when it falls to the 200-day moving average. Falls below the 200-day moving average and falls below my blue equilibrium line, that's a crash. Know the difference. If you can't wrap your head around it, this is not for you. Just get out before you lose all your money. All right? I really had to tell you guys and teach you guys that. All right? Another thing, these moving averages, when they start all when the moving average, the shorter time frame moving averages start crossing below the larger time frame moving averages, those are death crosses. That usually dumps the price. Here's the S&P 500 daily chart. We have shorter moving averages, shorter time frame moving averages starting to consolidate right here. Now they're consolidating. They could go either way, meaning because this is falling, but it's not falling. It's starting to level out. If the price dumps, then these moving averages start crossing each other to the downside, and that's a death cross. But because we have the plunge protection team and we have endless money being printed, they're trying to get the moving averages to start trending back up, meaning that would pull the price back up, TA-wise at least. I also see a huge green Ishimoku cloud here. Now that doesn't mean that we can't get a pullback and then higher prices, okay? Now, what does that mean? Does that mean tomorrow? Does that mean next week, next month? Most of the time, you don't really know. You just kind of have a roundabout idea. And then later in the future, you kind of keep looking at the chart, getting more evidence, more news events, this and that. And then that determines when you pull the trigger to take profits, to put on a hedge, to short. And it's not easy. It's not for everyone. You kind of have to be smart and have years of experience. It's not easy. Okay? You're kind of plugged into the matrix every day. And even if I am right all the time, but you don't understand what I'm saying, it's useless to you. And I just have to say that. All right. So, let's start with trend following. And the trend is your friend until it's not, I know. But it's still better than most. Any other type of analysis that I've ever seen. Works for me. This is either, I don't know what it's going to be, and I've drawn all of the scenarios, which are all of them, and you let the market tell you what it's going to do. And once you get confirmation, then you respond and react. Can mining stocks drop and gold drop if the market crashes again because of margin calls? Yes, absolutely. It's always a risk. What do I do in that type of scenario? And there's a couple options. You try to get out, but usually you're not going to be able to get out because what they're going to do is dump the price overnight. And then as soon as the market opens next morning, it's too late. That's pretty much what happened last month or the month before. That's what happened last time. There's nothing. At that point, I was like, well, what am I going to do now? It's too late. If I sell now, maybe I'm selling at the bottom. So what you like to do is you put on a small position to hedge all of your longs. And what that does is it's a small hedge. And options are a great way to hedge. But you don't always have to use options. You could hedge with inverse ETF, leveraged inverse ETF. But then again, you don't do that type of stuff if you're not experienced. If you're just long in mining stocks and none of them are leveraged, then all you do is it's really just a buying opportunity in a larger macro cycle because you're an investor, you're not a trader. If you're a trader and you do have long leverage ETFs or something like that, then what you do is you hedge. I put on a hedge yesterday. It's already working out for me because the market dipped today. Mining stocks dipped today. Maybe it's the beginning of a pullback. It's fine. I'm hedged. All right. All right. So, but anyways, here's the S&P 500 monthly chart. Again, I don't think this year we're going to see new all-time highs in the S&P and the Dow. In the FANG index, yes. In the NASDAQ, probably. All right. But the S&P and Dow, that's a little different. It's a different story, right? Now, the countries are opening up. I think it's over for now. Second wave, who knows? There'll probably be something, but we'll get there when we get there. I think it's going to be that my last video, that W style of recovery. So it's kind of like this, right? And then slightly higher. It's like a lazy W. This is what I think they want to do. And the difficult part of all of this is you don't know when their manipulation and when the Fed's money printing comes to an end. You don't know if there's going to be another unknown event, an unknown, which is a black swan. If if a war breaks out or something, you don't know when China's going to dump the treasury. You don't know those things. But let's say none of that comes true in the next year or two. Don't look at the bottom of this, the time when I draw, because I can't draw perfectly versus time in the world, okay? Because you're not going to see it if I draw a little thing, right? But I'm saying, I'm just drawing you guys something. It doesn't mean it's going to go out to 2023. Here, let me draw it again. Something like this. And either the stock market just makes new highs and melts up even higher, or it can't make new highs and then it just starts trading in a range sideways until the dollar seriously has some serious problems and then crashes. Either way, I'm not fighting the Fed. That's why I'm buying metals and metals miners, mining stocks. Because fighting the Fed is, you're crazy. That's why shorting the market is super, super risky. Also, when you put on shorts, I suggest you use a small amount of money and then to maximize gains, you leverage it up, but know the fact that you could lose that entire position size, which is how you use options. But honestly, guys, don't trade options if you don't have many years experience trading them, because you have to understand time versus price into the future, and it could be many weeks and months, and that most people can't get right. Not that I could get it right, but I at least know when to sell the options when they're up massively. Anyways, but it doesn't mean like you could only get rich by leveraging up and using options. You could buy mining stocks, not leverage anything, like a retail investor, and you're still going to see 10, 20, 50 possible X returns. But you have to wait it out. It's going to take a couple years. Still better than going broke, because that's pretty much what's going to happen to everyone else. Still the largest wealth transfer in human history. Matter of fact, silver is alone, the price of silver could go up 10 times. That means the mining stocks could go up 100x easy. But you got to be in the right ones. They're not all, well, all might go up, But I'm saying in the end, you still want to be in the ones with the best fundamentals, best geographic locations, best business type models. Uh, there's types of mining stocks out there with a lot less risk, but a ton of upside potential because of the way the mining stock business is structured. Okay, and then you have to look at you have to look at, like Katusa said, swap lines, geographic locations, and I knew all this before I started researching and all that. It's pretty common sense actually. All right. What else do I want to show you guys? So so what's gonna happen with the markets? Okay, well, this is a monthly chart. Let's go to a daily. This right here, this is a pretty nice bull flag. Well, actually right here, this is a rise, this is a symmetric triangle. It's kind of like a pennant, but also kind of a bull flagish looking thing. But what I like about it is, see the price? It tests this resistance, breaks through that resistance, tests my blue equilibrium line, tests it again and again and again. It's testing it pretty much, well, for sure 3 times. And what's my trampoline analogy? It works both ways, down and up. You're a kid and you're jumping on one of those giant trampolines. Let's say you poke a little hole in it. Maybe there's a rock in your shoe. You jump on it again. The hole becomes larger. It rips more. You jump on it again. It rips a lot. And then the third or fourth jump on the trampoline, you fall right through. Well, that works up and down. So this is the trampoline, right? The hole, we poked a hole here. It's becoming larger. Now it's huge. If the market goes back up again, it's going to break through it and it's going to rise. So this is a daily chart. I expect to see some more upside. On the S&P at least. Now, of course, there's resistance. For one, we have the 200-day moving average. We have the 100-day moving average. And, it's right up here. It's very close. It's like around 3,000. If we break through 3,000, we're definitely, I feel like, going to test 3,000. Maybe this week or next. And then if we break through it, we could rally up to the 23.6 fib retracement at 3,100. But I think once we get up there, I think we're due for a serious correction or a pullback. It's either a pullback or a correction. I don't really know. We'll see. I already put on my position to profit off of the market going down. I like to be a week or two early to those. So yeah, that position will not make me money. It will lose me money for a week or two, but I don't care. I would rather be early than late, especially when you're doing options or something like that, right? Because of the premiums when you're buying them. Because when you're early, then you get the best prices and the cheapest prices on options. But if you're not using options, you still want to be early because, again, sometimes something happens, news event, and then it happens sooner than expected because nothing's ever for sure with markets. But I do expect a pullback or a correction. At least a pullback back down towards 2,800, 2,700, right? Or even to 2,600. 2,600 would be great. And that's probably next month, sometime in June. Because I really only think there's another week or 2 weeks max with the markets going higher and higher. and then a pullback. This would be a pullback in the grand scheme of things. Unless it really goes further back down to the 78.6, I would say that's a correction. But I'm expecting a pullback. They won't let it fall that low. And also, that doesn't mean the market's going to crash or anything. It's just once the price right here stops and then rebounds, that's a pullback. Nothing more, nothing less. And then what you do is you wait to see if you make a new high or if you start trading range bound and it starts consolidating. So this is what I'm expecting for the summer doldrums, right? Because there's less volume in the summer. Especially this summer, I feel like a lot of investors are just going to take a huge break. And they're going to sell for the summer so they could take their vacation and enjoy the sun because they've been cooped up in their homes or apartments or condos. And they're probably going to take a break and they're just going to sell. It's May right now. Sell in May and go away, right? That makes actually perfect sense. Sell in May right before June and go away. And then and they'll come back towards probably the end of July, something like that. In the meantime, the market's probably going to trade. We're going to get this nice pullback. Now, during this pullback, if it's an orderly pullback, which I think it'll be orderly, it'll be a slow pullback, slow grind for a few months, which is actually positive for gold, silver, and the mining sector. When the stock market's crashing, that's bad because you get margin calls. When it's pulling back slowly, metals could go higher, no problem. Matter of fact, they might go into a bull market this summer. I'm actually expecting that. Meanwhile, every other YouTuber out there and so-called professional traders like, yeah, these mining stocks, they've gone up 100, 200%. They've been doing really, really well. It's time to take some off the table, and we'll come back later on. That's what everyone's thinking, and I don't think that's what's going to happen. I think right now we're getting a dip in the mining sector, and then it's just going to keep going higher because the Fed's going to keep printing over the summer as all the investors go into cash to keep the markets higher, and then that calls for higher metals prices. Matter of fact, 2019, even in 2016, we actually saw a huge raging bull market towards the end of spring through midsummer. And that's like the new cycle now. And it's like they haven't caught on to this. And I have a feeling that's what's going to happen again. Matter of fact, I hope there's going to be a huge rally and a melt up in gold, silver, and the mining sector this summer. And then I'll be looking to take profits later during fall. Because fall, I feel like that's when they're going to make the market melt up. Trump especially is going to shoot to make the market go higher and higher. Maybe even making new all-time highs so he could get reelected, right? Even though the real economy, and not just that, people are going to get back to work. There's going to be this euphoric, well, not euphoric, but this return to normal mentality. Probably, well, it's already starting now. But by the end of summer, I feel like everyone's going to really think it's going to get back to normal and things are going to be great again. And that people are going to feel like that. And then all of a sudden, probably early 2021, reality is really going to hit that the economy isn't really recovering all that much. And then we'll see. Okay. So let's take a look at a few other things. Man, my throat's hurting. Try talking for hours. I made a video prior to this, right? Try talking for 4 hours straight. The dollar. Well, for one, yields are pretty much at record lows, and they're trying to cap them. I talked about yields and stuff in my other video that's in the newsroom. Here's a monthly chart of the dollar. It looks like it really does want to break higher, but here's the thing. They don't want the dollar to go higher. And matter of fact, they're okay with the strong dollar because that allows the Fed to keep printing trillions and trillions. I guarantee you. What did I tell you guys this entire time? You guys will not believe the amount of money they're going to print. You're not going to believe it. Why? For one, that's what it takes to keep the music playing. For two, they could get away with it. And for three, the people are going to start demanding. Everyone's already listen. The amount of unemployment in the U.S. is absolutely insane. The amount of unemployment around the rest of the world is probably even worse. I don't know, but because we don't hear too much about it. But this is what they're doing. The U.S. Central Bank prints, then the European ECB prints, Japanese BOJ prints, then the Chinese. And what happens? They take turns. So this allows the dollar to stay strong, and it allows all of the fiat currencies to not really crash when they print. They all fall together and they lose value. But because they're all doing it and they're taking turns, it sort of gives them more time and the more ability to just literally print trillions and trillions. It's insane. This is like global manipulation to keep a globalized financial system afloat, even though globalization has pretty much fell apart and global trade has fallen apart, and now we have some serious problems between China and the US, and they're tied together, the US and China, because they make all our goods and we give them all their money. And the system, it's pretty much fallen apart. So I feel like in 2021 we're going to see the ramifications of that. But for now, they could sweep everything under the rug and keep the music playing with endless stimulus. Also, the people see, everyone notices that, Wall Street got bailed out, the banks got bailed out, and, the Dems are just trying to pass a $3 trillion stimulus package. And listen, no one wants to look like a bad guy before an election. So they have to compromise. And one of the compromises is, well, this time around, we need to give Main Street, we need to give the people some money. I just tried to sound like Bane and it didn't work out. For you, the people, when they need to give them some money because, for one, what the central banks are doing is not raising the velocity of money within the economy. So the only way to do that is to literally give helicopter money to the people, to the peasants, who just got $1,200, which covers nothing in the U.S. So to raise the velocity of money, to get things juiced and moving again, to get the gears grinding within the economy, they're going to send out more stimulus. I guarantee it. And again, that's the only way the people are going to accept all of this power grab, centralization, and clown show that's going on. And, the village people don't grab the pitchforks and torches. So they're paying them off. But the peasants don't realize that they're going to pay for this very soon in the future through inflation. All right. So where was I going with this? That's for now. So, yes, we'll see deflation in some sense, but not as much as I was thinking because they're going to print so much. It's going to prop up home prices and car prices probably for a little bit longer. They're going to fall, but instead of falling like 60%, they've only fallen 20 to 30%. So these asset bubbles like homes and cars, but commercial real estate, that just collapsed. Which I did put out some possible shorting opportunities like a month or two ago for the private group. What else was I saying? Anyways, that's my thought on that for now. So stagflation. Everyone's gonna get some more stimulus. It's a pure shit show, to be honest. Here's another problem that they're running into. Well, for one, we had the 60 minutes with Powell Sunday, and he pretty much came out. If you watched him, if you watch him, you could kind of see on his body language, his face, and everything. You could tell he is he's pretty nervous, and he's like, "Well, yeah, we have unlimited printing tools, and it's digital currency." And deep down, you could tell that he's like, "This is insane what we're doing." But I have to keep the confidence. It's a confidence game, right? Because all Ponzi's are. So he's like, don't worry, everyone. Don't worry, Wall Street. We have unlimited power to keep the music playing. That's pretty much what he's saying. Until the debt matters and the inflation shows up. When the inflation shows up, that's when their tools no longer work. It won't matter how much they print because the prices will just keep rising and rising of everything. So will the debt. And then it doesn't matter because everything just starts falling apart. And people can, you understand, as inflation rises, people stop shop. Well, for a while, they buy as much as they can, but then eventually, because inflation starts running away so quickly, people stop. They can't afford other things. They could only start affording food in the end. Anyways, yeah, I'm done with that. So check this out. The FANG index is very close to all-time highs, which is, of course, I've told you guys, the market is so heavily weighted in these international corporations that are super highly overvalued, in my opinion. All these index funding, because of Ray Dalio, they pull up the rest of the market. But when Apple and some of these big ones fall, they're going to pull down the entire market. And that's a damn shame because we definitely don't have free markets. And I talk about that, what it really is, in my other video that I posted in my newsroom. NASDAQ, also very close. It's on the left top corner. Is very close to its all-time high, which is insane. So let me show you the NASDAQ and the FANG index real quick. Here's the NASDAQ weekly. It's on a 7 count. So 2 more weeks of upside on the NASDAQ. According to the TDI indicator. I give it to my private group members. It's free. You can find it if you want. The FANG index on the weekly is also on a 7 count. That's why I already started hedging, and not hedging, but shorting the market by going long with an inverse ETF. I started off with a small position, then I'll add more as we get closer to the 9 indicator. A 9 is a sell indicator. So possibly, but look, we had a 9 sell last week, but it didn't work out because this candle's already trading above it. They don't always work out. It worked out here though. Check this out. Worked out perfectly. That's why I was able to time the market crashing a few months ago. It was very easy, to be honest. I don't know how everyone didn't see the top. I saw it. Anyways, 2 more possible weeks of upside on the FANG index here. So I'm already going short technically in anticipation of the market. But anything could set it off to fall earlier than the 9 count. All right, I always like to be early to any move and every move. Now, so it doesn't matter where the S&P and the Dow Jones are because I know that the FANG index will pull them down. That makes sense. Okay, I've been talking for 45 minutes. All right, here's the euro versus USD. I'm just keeping track of this, guys. Looks like the euro's getting some buying here. Although here's a long-legged doji that's usually bearish for the long term, but this is also a monthly chart. I think by the end of the euro's going to definitely revisit the 1.04 versus the dollar. Meaning, again, that's going to give more room for the Fed and Powell to keep stimulating. But again, I said they take turns. But I do think the euro is going to go before the USD. Or I think Europe's going to break up before the dollar falls. And that's where I disagree with Schiff. I disagree on I agree with a lot of people on a lot of things, but there's always other things I disagree with. If you guys ever pay attention. Okay, so here's the Dow Jones. Again, I feel like maybe 2 more weeks of upside. It might, there's already resistance at 25,200, at 25,700, and then there's resistance at 26,300. And I don't think it's going to get past any of these. Well, not any, but it might get up to the 61.8 fib retracement, make it go a little higher, and then I expect the pullback this summer. What's this? Okay, never mind. So I have an awesome chart I want to show you guys. I do want to talk. Okay, so here's the Dow Transports. Look how weak it is. Again, it doesn't justify this V bottom reversal everyone is expecting. So I do expect. So essentially, what I'm trying to say is, for now, this was a awesome rebound in the markets. This is the S&P 500. But what I'm saying is, I do expect a decent pullback, maybe a correction, I don't know, and then we'll see. But I do know, listen, they're going to juice the market on the pullback and just try to get it back up, and then we'll see if we can make new highs. All right, that's later in the year, right? After July, that'll be around August. Okay, this will be like around August or something, I'm thinking. Okay, so let's get to I was going to talk about crude oil. So when everyone was like, oh my God, oil is negative, this and that, I bought a bunch of call options and they're finally starting to go into the positive in a really big way. I mean, they're up like 80% already, and this is just the beginning. Let me get to the oil. Okay, here's WTI. I bought like literally when the sky was falling and the oil market looked like it was gonna just disappear. But I knew Trump was gonna. I knew they were gonna prop up the oil. Like, the world can't let oil and the oil refineries and the companies go under. I mean, oil is the most important energy in the world. Everything in your house, everything is tied to it. Okay, you don't have EVs without oil, guys. How do you think they mine for all the minerals for the batteries and for the components? And most of the components are plastic, and come on. Everything needs lubricated. It's all oil. All right. All the electronics, oil. Okay, so yeah, I mean, I bought these call options into the fourth quarter as farthest out as I can. Hopefully they're going to work out really well. And I think they will. And that was for the private members. They're already up like 80%. And this is just the beginning. Here's E-mini light crude oil futures. Look at this dead cat bounce. This is a weekly chart. Not a dead cat. This is a nice... I told you guys, the bottom's in. Now, there's going to be resistance at around 55 on the E-mini light crude oil futures. QM1. But there's a long way up. And by the time it gets up there, my options are going to look awesome. I even bought some into July, my very first buys. And I'm not saying now is a good time to buy. It's up to you. Consult your financial advisor. If you're a trader, this was Tesla. I wouldn't buy it, but I did notice those are head and shoulders. I'm just showing you guys this pattern. This pattern right here. Now the price does have to get back up to 866 to make a neckline. But whenever you see a head and inverse head and shoulders, it usually means you're going to get a nice breakout. Like that. So you see this? Shoulder, head, shoulder, breakout. I'm not buying it. It's not worth it. The stock's already $800. Cost a lot. So let me show you guys an awesome chart. Just give me a second. All right, here's silver, the spot price. And this is based on, so the last time, 2008, the Fed added 1.3 trillion and the gain in silver was 440%. Right now it's at 2.7 trillion. Technically it's probably going to be a lot more, like 5, 8 or something. This is where silver is right now. So if silver goes up and makes new highs, which I think it will, maybe double, triple, say it goes to 100. Last time it went to like $50. What if it goes to 150? I think it should, at least, because the above ground it's been depleted. And guys, I mean, 150. Go to Mike Maloney's YouTube and look up silver $150, no brainer, and he explains it. That means the mining stocks, like, life-changing gains. I'm not promising it. I'm not saying it's certain. I do think they've been manipulating the silver price low to keep it low so these big corporations can have cheap electronics because they all take it because it's the best conductor and it's for circuit boards and chips, right? So I think they've been depleting the resources and keeping the price manipulated down so these companies could have good revenue earnings. Because if the silver was stayed at a $50 or 100, your Apple iPhone would cost not $1,000, but like 3,000, not 3, but 2,000, right? And then people wouldn't be able to afford them. It's my opinion, my theory. Okay. Let me show you guys another awesome chart. Here's the BGMI, Barron's Gold Mining Index. So this index tracks all the mining gold miners, at least. Okay? This is where we are right now. This index, we're still near the bottom, guys, for the mining sector. The bull market, it's not like halfway over. It's not even a quarter ways over. It's not 3/4 or near the top. It's near the bottom still, to put it in the perspective. Yes, the window's closing for you to get like the biggest bargain. Like, it's kind of equivalent to the people who bought Bitcoin at $10 and then it went to 20 grand. It's kind of like that. That window is closing for you to buy it like at below 100 or $10 or something like that. The window, you know what I'm saying, for that is closing. So, you know, you don't want to miss out. And a lot of people are just stupid. They're just going to wait until the prices keep going higher and higher. And they'll wait until the bull market's halfway over or near the top. And that's when they all crowd in because, I don't know, it's human psychology. I'm not wired that way. It's going to go and make new highs, this mining index. Very, very important, all right? We're still near the bottom. If you understand this, then your mouth should be salivating at the gains we're going to see in the next 3 years. All right. Here's some of the mining ETFs. And we killed it. All right, here's GDX. This is GDX, the large cap mining ETF. I've showed you guys this chart before. It's gone up now. It's trying to catch up to the spot price of gold, but it still has a long, long way to go. Because gold is at its all-time high. Look at this. Now, everyone is expecting a huge correction in gold. Maybe a dip. and then it rebounds. And then what does that look like? Well, guess what? That looks like a giant cup and handle if we do get that. Cup and handle. So that's fine. I'm okay. Actually, I wouldn't mind another pullback or dip for the next week or two. But I'm talking about a dip or a slight pullback. Maybe back down to 1700. At the worst, like 1660. I'm going to look at the price again. Don't worry. But if it does do that, that's absolutely fine, guys. I hope it does so I could accumulate some more. And then midsummer, we're going to see a huge rally in the miners. By the way, as long as gold is above 1700, I think the mining stocks are going to rally anyways, even if gold pulls back because of their earnings and the fact that smart money's already buying. All right. Okay, so that was GDX. Let me show you GDXJ. Let's do a comparison. GDXJ is the junior mining ETF. Now, there's better ETFs than these. These are just the common ones everyone knows about. Here, let me make this, I'll make it yellow. The GDXJ. Actually, I'll make it green. Come on, it's not showing up. There we go. So that's the green line. These are the junior caps. So there's always more upside on the juniors than the large caps because of the market cap, and higher the risk, higher the reward, right? But there's more room to grow for juniors than large cap mining companies. That's all the way down here. Okay, so look. Let me draw. It's down here. Okay, so the last time the price of gold was at, let's say, 1770, the junior mining ETF was at $60. Right now it's at no. It was at $153. So GDXJ was like around $153 the last time gold was around 1770. Right now it's only at $23. So it needs to do a substantial multiples of itself, like a 500% rally, something like that. Of course I can't do. So it has to go up to $153 right now to catch up to the price of gold. And that's an ETF. ETFs don't perform as well as individual mining stocks, which I focus a lot on individual mining stocks. So the ETF has to do like a 5x to catch up with the price of gold. Some of the individual mining juniors will do 10, 15, 20x moves. And then what if gold actually goes even higher this year and starts making new all-time highs, which I believe is very possible? Why is that? Well, hold on. Okay, this is gold on the monthly. Why do I think this could easily make new all-time highs this year? Because there's not much resistance, and I know they're going to print more. And they're going to print more globally. They're printing globally. This is a global thing. So it's very easily gold could just shoot up past 2,000 to 2,700. And gold bugs don't expect that because they've been beaten down for the last 8 years. They've been conditioned to expect the worst. Just very easily this summer, it could just shoot straight up. If it does that, within a week, your life could change. That's all I gotta say. So, I think that's enough for today. I'm gonna leave it at that. In global currencies, this is gold and dollars. It's not at all. Well, I don't know. Globally in other fiat currencies. So if you're, in another country and you're in my private group, you work for your euros or whatever currency you make in your country. Well, metals have been making all-time highs in the currency you work for. For US, not yet, but we're getting real close. The dollar's been falling in value versus gold for the past, 2 years now? So for people who think like it's not in the bull market, you've already missed out in 2 years of it. Yeah, I'm just gonna end it there, guys. Smash them likes, leave anything in the comment section. Please share my videos. It's the only way this channel grows, and I'll continue to make them. Till next time.